Hello and welcome to our viewers on cruxinvestor.com and also to our listeners on Cruxcast, a new podcast series. We're here today with Ritchie of SilverCrest. How are you?
Doing well, thanks for having me.
You're in London, you're here last year as well, obviously, but tell us why you're here this year.
So we just put out a new economic study for our project. So definitely something we get on the radar for people. We've been to a few of these conferences before. We don't really have many shareholders over in this part of the world. We've got a very tight shareholder base with my old clients from a previous life of mine, being on the sell side. And getting some new faces and names to exposure would be great for us.
Yeah, I mean, we're hearing that a lot. So, I mean, tell us a little bit of what's happening in the sort of North American market at the moment with regards to mining natural resources.
In a broader sense, what you're seeing is people chasing performance, and the mining industry has had anything but performance for a decade. So what you're seeing is funds looking elsewhere, money being pulled out of those funds, so forced selling at lower and lower levels, and selling begets selling. And now we're at an issue with mining where we're at multi-decade lows in terms of mine life. My favorite chart, it was given to me by one of our holders, Donald Smith, who was trained by Benjamin Graham. And if you look at a ratio of a basket of commodities to the S&P, it hasn't been this divergent since 1970. So the opportunity set's interesting, but who can survive this time frame is the issue.
There you go. So, okay, well, why don't we start off, acquaint some of our viewers with your company. Why don't you give us a 2-3 minute overview, and then we'll get into some questions.
Great. The very quick and dirty would be three things. One is that we are in Senaro, Mexico, northwest Mexico, and we discovered, permitted, financed, built on time, under budget, and operated the mine next door.
Right.
And we sold that in late 15, and this asset's 25 kilometers away. So the first part of that story is that we've done it before, on time, under budget. We know the people, the community, we've got a license to operate. Part two is that we've got the third highest grade primary silver deposit in the world. So when silver prices aren't doing that well, and you've got economics that
that's top quartile.
Yeah, exactly. Right. So that's there. The third part is what's left on the upside. We've been able to hit on about 70% of our drill holes, and our finding cost per ounce to date is 25 cents.
Right.
So those are the three main things. And like I said, I did mention that we do have our preliminary economic study that came out last week. It shows that in the first 4 years of production, we'll be able to produce an ounce of silver at less than $5. Right, so here we are with half the industry struggling to make any money. We're going to have roughly $10 margins at today's prices.
Which is incredible, right? Okay.
And we've got a payback period of 9 months.
So that leads on quite nicely to finances. Why don't we cover some of the basic numbers for the company?
Sure. So, I mean, one great thing is we have 33 million Canadian in cash. We've got about 4 million in warrants coming here. That covers us for about a year in terms of our budget. In that economic study, we need 100 million US of capital. And again, at today's prices, that's roughly a 9-month payback.
Right.
So again, the big majority that's going to be in debt. So it's not much equity or any equity left on that point. Alongside that, me spending 13 years on the sell side, we have a very strong shareholder base. So insiders own 16%. SSR Mining, which I'll touch on, they bought 9.9% of us. They're a major, it's about 5 times our market cap. I was in New York for 7 years. There's a big chunk of institutional investors who are in the story on that standpoint. So again, looking at the economics and why those people have been interested and they're supportive is, again, in and around today's prices, we should have a 78% IRR and a 9-month payback. Right. So one of the beautiful things for people who are not really trying to pick their timing on the market is we did a downside scenario case in that study, and is if you use 1,100 gold and $14 silver, we still have a 64% IRR, and our 9-month payback goes to 11 months.
Right. Okay. So there's some pretty impressive numbers there. So what's the problem you're trying to address? I mean, you're over here in London. You've talked about exposing yourself to more investors. I'm assuming you want retail investors because of the ability to drive, well, liquidity, bit of volume.
Yeah, I think it is interesting. Professional money managers are very challenged that they have to make money monthly. They're competing with other funds that are having performance in other sectors, and that's how they get capital. So they're very short-term in nature, and they wish they could be longer-term. Whereas if you're able to look at a longer time horizon, pictures tend to get more clear. So again, if you look at where we are as an industry and where the cycle is, and if you look at our ability to withstand that downturn, and then look to what the upside is, a retail investor, knowing that you still have an 11-month payback at $1,100 gold, you can buy this stock. And again, there's still risk related to mining. I'm not trying to downplay that at all. But you have a much better resilience to how long this cycle changes. And then your upside is something you get with the drill bit, commodity prices changing, and then potentially many people would say that we're a potential takeover target given our robust economics and defensive characteristics.
Right. And I mean, clearly when you're talking to institutions, they've got a whole bunch of different concerns. I mean, what do those phone calls sound like when the end of each month?
Broader based, I mean, you can look at time zones. I mean, a lot of people in Europe tend to look sort of through Africa and places and whatnot. And a lot of people in North America kind of go Canada, US, Mexico and whatnot. People ask about Mexico, and there's certainly good parts of Mexico and bad parts of Mexico. But I mean, we've been in this area for 13 years. The largest political organization in Sonora is the Cattle Association. They have an export agreement with the U.S. for beef. We're in the Cattle Association. We have our own ranch now. There was a spill in 2014 by another mining company that didn't clean it up. We spent 50 grand of our own money buying fresh drinking water for the people, the horses, the cattle. Our CEO's son and daughter live on site, and they have lived on site for a long time. So it's a question we get asked, but it's not something we're overly concerned about. Again, industry-wide, why do I need to invest in the space, which is kind of applies to anyone on that front. Permitting, people ask about permitting.
So, but can I ask, what is the answer to that question?
Which one?
Why should I be investing in this space? I mean, is mining still relevant?
Well, again, I was on the sell side and I quit to take this job. And mines take on average about 7 years to come online. So when you talk about 50-60% of mines not making money today, that also means that the next asset most companies have in their portfolio don't make economic sense today. So no one's spending. A lot of people are doing this waiting for that commodity price to turn. And it's interesting for a lot of people if and when that happens. But they don't really have many strategic decisions to make today. So if you have an asset that can withstand the downturn and then participate with the upside, that's pretty significant, because you're not going to see new supply coming online until the price moves. Then the investment cycle starts, and then you've got the 7 years.
Yeah, I mean, there's 7-10 years. People use different numbers, but the net result is the same. It takes a while from when you start to when you get into production.
We're in multi-decade lows in terms of mine life right now.
For sure. So, given that, what are the challenges that you faced last year through to this year? You're sitting on a bunch of cash, gives you lots of optionality. That's great news. Okay, you're one quartile in terms of cost. Fantastic. So you're quite attractive for lots and lots of reasons, but what's happening next? Where's the value come from for new investors coming into this story?
The best analogy for that is our one key area within our mine is extremely high grade. It's the first ore we're going to access in production. Our first drill hole into that area was 3.5 meters wide at 8.5 kilos. And obviously we got excited. We threw 4 drill rigs at it, and 4 months later we had 40 million ounces at over a kilo. So, if you look at the PEA that assumes 13.7 million ounces of production in each of the first 4 years, if you assume roughly 16 million ounces are needed to get those 13.7, if you can find 40 million ounces of high grade in a short period of time, I mean, that conversion to free cash flow, again, 13.7 million ounces in the first 4 years, that's 115 million of free cash flow per year. And our market cap today is 270 million.
Right.
So the speed of finding high grade can move the needle very, very quickly on the drill bit.
Of course, but that's ifs and buts. So what are you guys doing to ensure that, or as much as you can?
Well, we've got 15 drill rigs on the property today, and that's one of the bigger drill programs out there. Half of those drill rigs are trying to convert the resources to reserves, just to increase the confidence and remove some of that risk of having more tangible belief that it's there and we can control it and understand that. And then again, the other 7 are looking for new ounces. The beauty with us is we're actually a small mine. It's only 3.8 million tons are in our PEA. So even if we find some lower grade ounces, maybe there's the potential to go from 1,250 tons a day to 1,500, 1,750,
Sure.
and see how it plays out. So it's any ounces we find now that are economic, can
Right.
add some leverage, get some economies of scale. So the first thing we're doing is drilling aggressively. In terms of also mitigating risk, within our PEA, we used very prudent, I won't say conservative because you don't know until you're actually producing. I'll say very prudent inputs. So the recoveries that we are seeing in the studies, we used 4% lower than that in our PEA. The mining method we used in our studies was all cut and fill, which is a more expensive method, and there is a good chance that part of the resource we could use with long hole, which would cut costs. Grade capping, conservative on that front. And again, we didn't assume any upside on the throughput. Maybe we can get lucky with building a power line, which would have significantly lower power costs.
Right.
So we made sure that given a 78% IRR, if people
Yeah.
don't believe your inputs, the thing goes in the garbage. So we wanted to make sure we started out so people can go, here's a snapshot in time, here's what it's worth, we believe you, or we're going to make our own adjustments and come up with a number. And everything is kind of gravy, hopefully.
Yeah.
And that number today is trading at about 0.65 times our net asset value.
Okay, so yeah, I agree. Those are reasonably conservative assumptions.
That was the attempt.
In inputs, which is great, but yet the IRR is definitely up there. We've been talking to people with much lower IRRs this week who, with a slow and steady approach. Now, so in that context, how do you get the balance between running the company, mitigating all of this risk, all these moving parts where if something goes wrong, it affects everything down the food chain, and creating shareholder value? Those are 2 very different skill sets.
So our CEO is a geologist and a mining engineer.
Right.
He's built 6 mines, again, including the one next door. Part of my role of coming on was to sort of spend more time in the capital markets and whatnot so that the people who are on site adding the value can spend more time on site adding value. We recently added a COO who designed and built Canada's largest gold mine. He joined the company on the board last year, but officially as COO at the end of last year.
Right.
And threw in about $300,000 of his own money on day one on that way. So again, adding some more bench strength to the technical team is a significant part. We've got a good cash balance. I mean, December of 17, we had $3 million on the balance sheet.
Yeah.
So we've been slowly making sure we pick up that cash balance. What we're doing in the asset, again, doing infill drilling to make sure we have confidence in what we have in place. Making sure we're communicating with shareholders all the time, and we've got a very strong shareholder base. I mean, most of these shareholders were my old clients in an old day, so just making sure that communication and trust and transparency is there.
Right, but those institutional guys, presumably,
Correct.
the big guys, right? And they're very technical, very knowledgeable in terms of what they want. But at the end of the day, they still need share appreciation. That's their key driver here. So are they telling you what to do, or do they sit back and what in terms of strategy? I'm talking about, obviously not technically, but in terms of strategy, are they talking to you about what they think you should be doing in terms of creating a bigger entity? Because your market cap is good. It's like $300. That's pretty impressive. But I think from what you're saying, you feel it could be more. So are you frustrated with the performance, or you think it's okay?
No, if you look at our performance versus the GDXJ, which is an ETF for junior miners, I think last year, that GDXJ was probably down about 20%, while we were up 150%, I don't know the exact number. So it just shows that, again, while the gold and silver prices are low, we've shown that we're a vehicle that can add value, and that's mostly been via the drill bit. Right. So what we're getting from our investors is, we'll give you the latitude to go out there and drill like crazy, because again, that's what's been driving share performance. So the bigger and broader we can just make this asset in terms of either, again, leverage tons or high grade, that can move the needle very, very quickly on that front. So that's their main push on that, and continue to de-risk. Get that permit, which again, we've started a long time ago. We got one major permit left. Hopefully that's something that happens this year. And they're also telling us to hurry up and drill because, again, with an asset like this, there's been a huge wave of consolidation been taking place. If you can't get growth and upside and the commodity price isn't working, you've got to manage costs.
That's the next question, which is, the other way this works is if silver price goes up, right? And what's your expectation in the marketplace at the moment? Because it's been a kind of very confusing year for a lot of commodities where people have catalyst events happening where normally it would have an impact. It's not. What's happening in the world of silver?
I'll answer it twofold, and I would say the way to answer that is very dependent on if you're talking to a retail investor, an institutional investor, or a management team trying to run a business.
Okay.
And I'll start with the management team trying to run a business. If you're a management team trying to run a business, your assumptions on silver is that it's going to be here or lower for the next 5 years. Because if you're not doing that, you're not being very responsible. So looking for low cost, low capital intensive assets that can give you more margin to wait it out is a prudent approach. If you're buying something top of cycle and the market rolls, your head's on the line.
Yeah.
If you buy something and the market rolls, but you've actually increased your margins and you've bought defense, you get a pat on the back. So again, that's the uniqueness of our asset. Now, if I was to tell an institutional investor, hey, look how good we are at $1,100 silver or 1,100 gold and 14 silver, they'll say, great, why am I buying if it's going down? So that's part of it. And the same as the retail investor, I would say same thing. If you don't have the monthly pressures, but you think it's an interesting long term, having something that is more defensive while you wait.
Yeah.
Now, we might not move as much as another name that's got $13 cost and silver goes up $2 and all of a sudden the margins go up 200%. But it doesn't mean you've solved the problem about what assets next in your portfolio. It doesn't mean you've all of a sudden got cash on the balance sheet. It's one might have short-term share price performance, but again, how to manage a business is very different under all those scenarios. That's why I wanted to answer that in those ways.
Yeah, and I think that's fair enough. You need to look at it like that. Okay. Investors are always going to be looking for share appreciation. Okay, so you can do that by drill bit, expanding out, building out your resource. Fantastic. You can do it through M&A. Any M&A planned, or have you got enough on your books?
I think our shareholders would be very happy if we put our head down and focused on this asset and did not get distracted. Right. Any M&A things that we'd be interested in are very much things in the neighborhood, $2, $3, $4 million that might be something close by that we can truck to our existing. Yeah, and get that economies of scale sort of thing. And again, we've been in the neighborhood for 13 years.
Yep.
So knowing that all those things are available, and it's everything very low cost, but very potentially high return. Where, longer term, if you said 5 years from now you're in production, you've got a bunch of cash on the balance sheet. If the market was still soft, maybe we've had a vehicle that could re-rate cash and we could be able to self-finance future development and grow this company while other people weren't necessarily in that position.
Yeah.
And if the market turns 5 years from now, maybe we've actually enjoyed that downturn to accumulate those assets and build a bigger, better, stronger company.
That's interesting, Chris. I'm going to wrap up there. I think we've run out of time. You need to get dashed back to the one-to-one conference. How are you finding it?
It's great. It's good. Like I said, we have most of our shareholders are over in North America, so just being able to tell the story and get people's feedback over here is it's a good use of time.
Yeah, it's a very good conference. I think you'll enjoy yourself. Anyway, thanks very much for your time.
Thanks so much.
See you again soon.
Appreciate it.
Thank you.
Cheers.
Thank you very much for watching our video. We do aim to give you informed and intelligent information with which to make your investment decisions. So if you liked what you just saw, please give us a thumbs up. And if you want to see more insightful, in-depth, honest and unbiased interviews, then please click the subscribe button. So thanks again for watching, and we look forward to seeing you again soon.